Stava, Global Head of Electronic Trading at Invesco, which is a very new and unique role in the industry. I'm not aware of many job titles within the buy side that relate to electronic trading. He has a very interesting background, operating on both the buy side and the sell side, formerly at Credit Suisse, and involved in their researching and consulting team, and now responsible for overseeing the electronic trading team at Invesco, which looks at trading research, algorithmic development, EMS technology, and covers electronic trading across the full range of asset classes and regions that Invesco trades in globally. So welcome to the stage, Rob.
Thank you. It's going to be a tough act to follow up the Bitcoin story. I know that I'm the only thing between yourselves and refreshments, so I will try to tell my story here as quickly as I possibly can. I'd like to thank the Trade Tech organization for inviting me to come here and speak with you all. I'd like to start off my comments to you today by first telling you a little bit about Invesco, and then sharing some of my views about how buy-side trading desks would need to evolve to thrive in this new execution environment. Invesco is a leading global investment manager that currently manages about $790 billion in assets. We operate under a few brand names, namely Invesco, Invesco Trimark, Invesco Perpetual, Invesco Power Shares, which famously manages the Triple Qs product, and Wilbur Ross. With more than 740 investment professionals around the world and 5,800 employees, we provide a wide range of investment strategies and vehicles to our clients. We have a hands-on presence in more than 20 countries and serve clients in over 150 countries worldwide. We are a publicly listed Fortune 500 company and are headquartered in Atlanta, Georgia. I work on Invesco's global trading desk, which has 53 members in all that operate out of 7 countries. We have a strong presence in each of the 3 major regions of the world. The global trading desk at Invesco has the responsibility for trading global equities, derivatives, foreign exchange, fixed income derivative instruments for a variety of investment centers. Through this address today, I'd like to share with you all some of my views about how some aspects of our industry are evolving and will likely continue to evolve in the future. One of the key factors, as has been mentioned earlier today, that's contributed towards the changes in how buy-side trading desks operate is portfolio managers and trading desks alike recognizing the importance and value that trading can bring to the investment process. There is greater recognition now, perhaps more than ever, that one of the key factors that affects returns are costs associated with the implementation of the investment decision. There is stiff competition in the investment management industry. And quite often, the difference in performance between the number 1 ranked mutual fund in a category and the number 10 ranked mutual fund is in the order of trading costs. If trading costs can be marginally lowered, it can have a significant impact on the fund's rank. Quite clearly, if differentiation can be realized in the trade implementation process, it could bring a material advantage to firms. But it's not just that. If the implementation costs can be minimized, it can have a dramatic influence on a variety of different factors. For example, capacity. The amount of assets that a particular investment strategy can hold has a direct relationship with the trading costs of implementing that strategy. All else being equal, the higher the costs, the lower the capacity of the fund. In a similar spirit, turnover. If the trading costs are lower, then the fund manager can afford to have higher turnover, all else staying constant. And finally, if the implementation costs are lower, there is naturally a larger universe of investment strategies and ideas that are available to the manager. The firms that get this are highly interested in understanding, measuring, and improving trading performance. Drawing on my sell-side experience here, I believe that many buy-side firms find themselves in unfamiliar territory when it comes to optimizing the execution process. There are 2 significant reasons why this is. The first is there's a general lack of robust measurement and analysis techniques and credible vendor products to evaluate execution quality at various levels of the trade implementation process. The process being divided up into 3 phases: the broker, the trader, and the portfolio manager. The second reason is that there's a dearth of well-defined processes that can be leveraged to optimize trading performance. So even if you could measure the trading performance at each level of the hierarchy, you still have to know how to optimize it. Historically, many firms have looked at transaction cost analysis just to satisfy their internal best execution committees or boards. The fact is that the buy-side community at large has found it challenging to be able to really leverage and harness the power of TCA. Turning TCA into actionable advice that can be used to drive changes in behavior, and that later can be used to measure, that later can be proved to be advantageous to the buy side, has always been a challenge. Here's a simple example of what I'm talking about. Suppose that you receive a TCA report from a vendor that shows performance of two brokers, broker A and broker B. Both brokers are being used for VWAP, and the report shows you broker A's performance versus VWAP is 3 basis points, and broker B's performance versus VWAP is 5 basis points. Based on this information, can we infer that broker A is better? Does anyone want to take a guess at that? We probably need more information, right? Now let me just add another piece of data here. Let's say that we now know that both broker A and broker B, the average spread of the stocks that both brokers traded was 5 basis points. Can we now infer that broker A has better performance? The answer is still no. In fact, few buy-side trading firms are truly equipped to answer this question. And while the answer to this question may seem inconsequential, it has greater implications. The problem is you can't improve what you can't measure. And while really, truly, if the firm doesn't know how to answer this question of whether broker A is better than broker B, it likely isn't equipped to answer the question of whether they did better this quarter versus last quarter, or if trader A is better than trader B. And by extrapolation, the all-important question that what changes are necessary in their trading process to improve performance and lower costs. It's not like buy-side trading desks haven't been focused on improving performance. Of course they have. But what's been missing from this equation has conclusive quantitative evidence that their actions or approach does in fact lead to better trading outcomes over the long term. This is clearly a fairly complex task. So just to recap, on the one hand, we have a buy-side trading community that has a strong desire to measure, monitor, and improve trading performance. But historical evidence suggests that there's a lack of sophistication and tools on the buy side to be able to respond to this need. This mismatch between wants and core competence is creating a need for a trading desk to evolve. The first dimension of how a trading desk must evolve is around the greater use of quantitative analysis to drive decision making. Buy-side trading desk must evolve and develop core competence in being able to mathematically model and quantify different phases of the investment process. What's needed is a new breed of data mining algorithms and techniques to help trading desks understand which behaviors and processes are leading to statistically better outcomes. Trading desks need to position themselves to be able to fully harness the power of trading data and to drive decision-making at all levels of the trade implementation process. And there are many areas in which these insights can be useful. Starting with the portfolio manager, Matt mentioned this morning about alpha profiling. Does the trading desk have a quantitative understanding of the alpha profile of the PM? Can they quantitatively confirm that there's no misalignment between the alpha profile and the PM and how their orders are traded? Can we measure if traders are using the tools available at their disposal effectively? Or is there any misalignment between how traders are trading and how they should be trading? Which traders are better? Should the trade be executed as part of a program or a single stock? Should the trade be, if the trade is to be executed in part of a program, what is the most efficient way? Agency or blind risk? What advice, insights, tools, and data can we provide traders to help make decisions in real time? Which brokers have better algorithms? Are brokers writing their orders efficiently? This is just a sampling of the kinds of questions that buy-side trading desks can and would be able to answer conclusively by utilizing more sophisticated data analysis algorithms. As we become more sophisticated consumers of quantitative research, we can expect to see substantial changes in how buy-side trading desks operate. First, the change in the ethos on how the buy side is migrating to a much more data-driven approach to decision making. It's likely that this migration to a data-driven approach will be accompanied by a growing number of quants and data scientists that sit alongside traders. Buy-side trading desks will need to foster a high degree of collaboration between quants and traders. As more firms are able to pinpoint differences in algorithm performance across providers, the execution portion of the commission wallet will likely be allocated in greater accordance with the same. Following the same train of thought, there will likely be greater rationalization from the buy side on which firms the trading desks use and why they use them. The buy side and sell side will likely need to engage in a different type of dialogue moving forward, where there's much more constructive interchange of ideas to improve execution performance. At Invesco, we've hired two more quants in the trading department in my team that are aligned against the task of execution research and analysis. One of the quants has a PhD in applied mathematics and the other has a PhD in math. Both are highly experienced in analyzing trade execution and being able to optimize it. In order to accomplish the goal of optimizing trade execution, one of the first things we did was to create a quantitative research platform that since its creation has empowered us to ask and answer many of the questions I raised earlier. The platform comprises of a data repository that links every order a portfolio manager at Invesco has sent to the global trading desk, how those orders were worked in the marketplace by the traders, and which fills we realized in the marketplace. This all is tied back together to create a full audit trail of what happened with our order. The data from this repository is analyzed with the help of algorithms we've implemented as part of our research framework, which has helped us improve execution performance. To give you an example, at the broker level, we wanted to optimize our uses of electronic trading tools offered by the sell side. To that end, we created a standardized electronic trading tool for our US trading desk. Orders are routed from our desk to brokers that are involved in our experimentation in the random fashion, and the results are analyzed. Creating such an experimental framework clearly required a lot of immense collaboration between our traders and our quants. The data set that we've collected over time is now being thoughtfully analyzed and controlling for factors such as spreads, volatility, order sizes, and market capitalization. This has allowed us to measure and compare broker algorithms on an apples-to-apples basis. We've taken the insights that we've gotten from this process and have started to reward brokers that perform well in our experiments. This sort of competitive framework has also aligned our interests directly with the brokers on the sell side and created an environment where there's a healthy exchange of ideas. We are now in the process of expanding this effort globally and have invested in a global cloud-based tick data solution to facilitate our efforts. Compare this to the highly subjective approach that most firms have to evaluating broker algorithms, evaluating if broker algorithms are effective. I'd like to now also give you another example of how we're utilizing this research framework. At the portfolio manager level, we've undertaken a number of targeted research projects to optimize execution quality, again, leveraging the same quantitative framework I mentioned earlier. In one instance, we did a deep dive analysis of whether it makes sense to execute programs in an agency fashion or in a blind risk fashion or a combination thereof. More broadly, we have rolled out an online portal for our portfolio managers, head traders, and traders to allow them to review, visualize, and monitor trading costs and trends associated with trades. This online framework has granted us the ability to efficiently deliver actionable advice to all people involved in the trading process and create greater transparency and change in the ethos of our trading desk. The second dimension of evolution on the buy-side trading desk is happening in the technology realm. And quite clearly, this is a technology conference in some ways, and I want to talk a little bit about the change that's happening on the buy side in the technology realm. Historically, buy-side trading desks have had limited appetite for taking ownership of technology. With many desks supported by corporate IT personnel, managing sophisticated technology solutions hasn't really been the forte of the buy-side trading desk. The most common solution has been to essentially buy a vendor platform and have the vendor customize the solution to their liking. And for the most part, this seems to work okay for the vast majority of the firms out there. But more recently, the need to bring about differentiation in the implementation phase of the process has fueled a growing appetite from the buy side to take greater ownership of technology. For our firm, some of the evolution in the technology realm relates to the infrastructure needed to store and analyze data, as I've talked about already. But as we're getting smarter about analytics, data, workflow, and processes, we wanted to realize these changes in our technology platform, namely the EMS, and we ran into some limitations with that. It became clear that asking vendors to customize their platform was one possible way for us to realize our views in the form of technology solution. But this would quite clearly come at a price. Suppose we had a great idea that we thought would help us realize better trading outcomes over time. If we asked a vendor to implement the solution, instantaneously, if the vendor implemented the solution, that solution would now become available to everybody else. And the advantage that we had in being able to use that idea would be gone. And so therein was the problem. What we realized was that if we truly wanted to create differentiation, a highly differentiated execution platform, it would only be possible if we were willing and able to take greater ownership of our technology platform. And that's exactly what we've done. We conducted a bake-off last year and amongst a handful of EMSs and have selected a global EMS, which is going to become the centralized hub of our execution activity across asset classes and geographies. By implementing the solution, we now have the ability to freely implement our ideas and retain our intellectual property. The desire of the buy side to take greater control of technology requires that the buy side evolve and develop core competence in being able to develop trading solutions, or shall we say, a new breed of algorithms. This too is going to drive substantial changes on the buy side. Firms like us have had to completely refactor the ethos of the IT staff that historically supported our trading desk. Instead of personnel that supported the vendor platform, we now require top-class trading technologists capable of implementing solutions that can add value to our process. At Invesco, we formed a team of technologists and have made some key hires in the team to help us realize this end goal. Working closely with quants and traders, the team is focusing its energy on creating value-added solutions with the end goal of realizing better trading outcomes for our clients. That was the second dimension of change, our evolution on the buy side. Finally, I'd like to talk to you about what I consider as the third dimension of evolution on the buy side, and that's in the electronic trading realm. Over the last several years, in every region and every asset class that we trade in, all signs point towards the growing adoption of electronic trading. Many firms are increasingly recognizing that no matter which execution channel they put their order in, the order ends up in one form or another in a computer algorithm. These changes are driving significant trends on the buy side. Firms that have historically been reluctant to change their approach are increasingly embracing electronic trading. Many buy-side firms are coming to the realization that in order to position themselves to realize the best outcomes for their clients, they themselves need to develop much deeper understanding of the market structure and electronic trading tools, and therefore need to invest heavily in exercises that are geared towards those goals. Many firms like us are trying to take greater control over how their orders are executed. As these trends continue, over time, we should expect to see a greater portion of the buy-side order flow being executed electronically. Our view at Invesco is that the use of electronic trading tools to implement investment decisions has become a crucial part of the investment process. And since we are keen on realizing differentiation at all phases of the investment process, we have decided to develop our own proprietary trading algorithms. We have hired a developer from a major high-frequency trading firm and have aligned him against the task of developing our strategies. This, in our view, is the natural extension of the buy-side's role in algorithmic trading. This new breed of proprietary trading algorithms will allow us to more closely align how our orders are executed in the marketplace with the ultimate investment objective, and as a consequence, help us realize better trading outcomes for our clients. In conclusion, there are transformative changes happening on the buy side, and in the quest of superior performance, buy-side trading desks are creating a new breed of algorithms and evolving in a few important dimensions. Trading desks are becoming much smarter at using quantitative techniques to drive decision making, much more sophisticated in their use of technology to create solutions for themselves, and taking much greater control of their orders in an effort to realize better performance. These changes, I believe, will set the tone for how the buy-side trading desk will operate for some time to come. Thank you.
Thank you very much. One quick question. Given that sophistication, how is it going to change the need for the broker in your electronic trading and how you interact with them and the use of low-touch trading offerings through the brokers?
That's a great question. Thank you. I think that I talked a little bit about electronic trading, but quite clearly there are many dimensions of trading that we need to be good in. high touch, which my colleague Wendy Miller will talk about later on today. Brokers are clearly an integral part of that, certainly in that realm. In the electronic trading realm, as we develop our own execution algorithms, we will be benchmarking our strategies against the broker algorithms. And we'll trade with the ones that we think are going to help us get the best outcome possible.
Okay, great. Thank you very much.